All right, what is going on, everyone? It's been a while since I had posted on the YouTubes here. I've actually been up to quite a bit over the summer, which is part of the reason why there's been a delay in posting any content. But in short, I am now officially a cryptocurrency miner. Yip yip hooray, good for me. It's all exciting stuff, and that's part of the reason why I've been away. So I want to get into a few things in today's video. First and foremost, look at this sick, nasty desktop because I also upgraded my computer. Got rain meter sitting here in the background, so I get a live view of the clock, core, computer details, speed of my internet, and then I have a really nice little desktop going on here. Just to show you a bit of the task manager here, which I do think is fascinating. Let's see if I can pull this up here. So task manager, go to performance. You see I got an i3 13100F processor. Need to get that upgraded to the the 13th iGen overclockable version. 128 gigs of RAM, complete overkill, but fuck it, why not? Then I got a few SSDs here for storage. Got high-speed internet hooked up to the laptop desktop setup, as well as a GPU, a Intel Arc A750 graphics card. This is actually going on a killer sale right now on Amazon.com for about $250, in line with performance with the GTX from NVIDIA 3060 Ti, so definitely something worth looking into. But to get into the detail here, and why am I actually doing a screen recording video, which is not standard for this channel? Well, I want to talk to you guys about cryptocurrency, as I don't know if that's the direction the channel is going to be going into, but given that I've invested so much time into a company, which we'll get into more details about in just a sec, as well as into the space as a whole, given the channel is about, personal finance, investments, wealth planning, etc., I do see cryptocurrency as the 13th. Generally speaking, there are 12 major asset classes in the investable world, and I do see cryptocurrency as a sector, a growing sector, one that's going to make up an increasingly large portion of people's portfolios as time moves on into the future. And the cool thing about cryptocurrency is that it is such a new technology, despite Bitcoin coming out after the fallout of the 2008 housing crisis, that you in some respects are still very early into the space. Yes, Bitcoin may have traded at a peak of $69,000, but today it's still very cheap in relation to what it has been in the past. But I don't think, the moniker past performance is gonna not equate into future returns is really applicable here, given that we haven't seen the upper bound as to how much this market cap, how much the space, how much the industry is gonna grow into the future. To begin our conversation today, we have a major catalyst coming up for the cryptocurrency sector in, call it, about 199 days, 19 hours, 32 minutes, and 7 seconds. This is Bitcoin's next halving, and for a lot of the, I guess you could say, uninitiated, or just people who haven't spent a lot of time focusing on the sector before, Bitcoin is operating off of a proof of work model, and I think this website could explain it better than I could, so let me just read it out here. What is a block halving event? As a part of Bitcoin's core coin issuance, miners are awarded a certain amount of Bitcoins whenever a block is produced. Now, this skipped a whole bunch of information, which I do think is important to pause for just a moment. What do they mean when miners are awarded a certain amount of Bitcoins? Well, let me use a metaphor I explained to a colleague the other day, and that metaphor is the use of Venmo, right? Let's say you went out to a restaurant or a bar with some of your friends. You decided to split the tab, but one person actually made the payment for the meal, for the drinks, whatever it may have been, on their credit card. Well, given that you and them had decided to split the bill, let's say said bill is $100, you owe them $50, and you choose to send them the money via Venmo instead of giving them, cash, right? Well, when you make that transfer on Venmo, when you press $50 and then click send and then it goes into the other person's quote-unquote wallet, what is functionally happening in the background is that your bank is sending a credit to your friend's bank, and then over time, over the next few days and weeks, people within that bank are going to firstly validate the transaction, who is sending it to who, what is the amount that they wanted to send, when is the time in which it took place, and if there was some kind of labeling system, what was the transfer for. And that process can take a period of maybe 2 days, maybe a week. It really depends on the speed of the sending and receiving institution to settle or finalize that transaction. In the meantime, your friend who had bought the meal is receiving a credit, which is for them functionally going to act as cash, but in actuality for the bank itself, they have not yet received the funds from one bank to another, and they're operating on a credit and debit type system. The difference between traditional finance, if we want to use that word, or legacy finance, and cryptocurrency is that rather than the banks validating that transaction, making sure the right amount of money went to the right person at the right time for whatever it was for, they're actually going to have people with computers actively running an algorithm at all times of the day. And whomever actually can beat this complex calculation of code for whatever the number that it is trying to be validated, they'll have the right to validate or confirm that next transaction. When they confirm that next transaction, everyone else who has an interest in the cryptocurrency blockchain in question, in this case let's use Bitcoin, is going to have essentially a transaction history list be updated to reflect what has just occurred, what that other person has just validated, has just confirmed. And the cool thing is, like this website and like I think everyone who has ever read about proof of work has realized, is that when you actually validate that next transaction, you get paid more. So reading further into here, when Bitcoin first started, 50 Bitcoins per block were given as a reward to miners. After every 210,000 blocks were mined, approximately every 4 years, the block reward halves and will keep on halving until the block reward per block becomes 0, and this will take until approximately 2,140. So I hope you live that long. I'm pretty sure that I don't, especially with my lifestyle, but anyway. As of now, the block reward is 6.25 coins per block and will decrease to 3.125 blocks per post halving. Now, why is this important? I think this is good for us to take a little scroll here and think about, in the big picture, what is going on with the US currency. Well, this could be in its own video in its own right. There's a lot more people who are so much smarter than I am who could articulate this better. But in short, the US dollar is an inflationary currency. We have our government, the House, Congress, the President, the Federal Reserve, who have the right to issue more currency units for whatever purpose that they may want to do. And while, they promote it being under the guise of financial stability, and then the Fed's goals are stable prices and stable employment, they'll alter, change, increase, or decrease the amount of monetary units or dollars for achieving these ends. I personally think it's much easier to justify your existence when you're able to print out money and, pay for things like affordability housing and government subsidies and handouts and gifts and all these things. And I guess that gets into the whole realm of politics, which is kind of what we're trying to avoid here, at least on my page, because politics are devices. My point of mentioning all this is that rather than having an inflationary currency base, Bitcoin is deflationary. There's only ever going to be 21 million Bitcoin that will ever be created, that will ever be put into circulation, no matter what people choose to do, unless they radically alter the code and essentially go against or create a new chain from the base Bitcoin operating model. There's only ever going to be 21 million Bitcoin. And in relation to the US dollar, where each year the amount of purchasing power that you have decreases because there's more currency units to buy said fixed supply of goods and services, then you'll actually have a stronger, a more stable, a more long-term store of value than you would with the US dollar. This is a very similar argument to that of gold, and is one of the reasons why Bitcoin makes up a large portion, about 5% of my balance sheet at this time, because I view it as an inflationary hedge. It is a commodity in its own and most simple and most basic right. And what is a commodity in a big picture sense? A commodity is essentially a good that has a fixed supply, that's price is determined by people willing to buy or sell it on the open market for whatever they deem its value to be. And this can potentially create some volatility because there are no quote unquote underlying fundamentals as far as, I can turn copper into a graphics card, or I can turn iron into steel beams for a building. Bitcoin is solely used as a store of value, and its dollar denominated value is only going to be determined by what people are willing to pay for it. It's my personal belief that over time Bitcoin is going to have a much higher demand than it is supply, and then accordingly its price will go up. And the benefit to the price going up is that it won't be caused by something like inflation, you needing more of one thing to pay for another. it'll be caused by an increase in demand, which I think is a much more stable and a beneficial place for a asset to be, especially if it's for your long-term wealth planning. Not money that you want to spend tomorrow or next week or next month, but money that you might want to spend in 20 years. Now, getting into some of the details of today's video, I actually want to walk you through what I've been up to this summer. So I trade on Binance.us. Yes, there's a lot of cryptocurrency platforms out there. There's Coinbase, there's Gemini, there used to be FTX, but we know what happened there. The reason why I'm using Binance is because they still allow US consumers to stake their cryptocurrency for rewards, which gets into the broader picture of what the plan is with my portfolio. But let's take a step back and kind of explain to you what I did this summer. Well, I did a lot of research and I found a ASIC, a application specific integrated circuit computer, that's sole purpose is to mine cryptocurrency. And the cryptocurrencies that I'm mining are Ethereum Classic, and then I'm dual mining with Zilliqa. Now, we could speak into the broader implications as to if Ethereum Classic and Zilliqa are good protocols for the long term for holding. It's my take at this time that those are not the best coins that I would want to have in my personal portfolio, and rather when I get my cryptocurrency mining rewards for validating those transactions that we're speaking on about a little bit earlier, I'm actually diversifying those holdings into other cryptocurrency assets that I do think are going to have a much better chance of return and profit into the future. So at this time I got about $5,397.49 of cryptocurrency into the portfolio. Yes, we will be doing a portfolio breakdown. As of today, the portfolio is down 2%. As of the past week, this is extremely confusing, so I don't really think that's accurate. At the time of recording, past week is up 1.84%. Past month, there was a bit of a lull in the market, and I did make a massive deposit, as you can see here, for about $1,000. But for the month, we're down 4.38%. 3 months. Let's see here again before the deposit went in. About 1.31 for the 3-month return. And I think I'm going out to the all-time high, right? Really what I'm doing here is building up a position, and until the market actually gets to give me some return valuations, a lot of these crazy returns here, like 2,700, 4,000, etc., are just accounting for large deposits of capital being put into the account. Going into the portfolio breakdown, though, I want to tell you what I'm personally holding and the thought process why. We have Polkadot here, ticker symbol if you want to call it that, DOT. Polkadot is a layer 0 blockchain whose sole purpose is interoperability. One of the issues that cryptocurrency has as of today, kind of contrasting to some of those benefits that we were speaking about with the main Bitcoin network, is that one blockchain is unable to talk to another blockchain. And when you have application-specific blockchains that are very good for individual tasks, that might be beneficial to share that data with other cryptocurrencies and their data chains and their blockchains, you don't actually have the chance for scalability. Polkadot's main goal is to increase the scalability and interoperability between cryptocurrency blockchains. And what that means is if I'm speaking English and you are speaking Spanish and another person is speaking Mandarin, you can think of Polkadot in some respects as a cryptocurrency translator, allowing blockchains that normally wouldn't be able to talk to each other to be able to talk to each other. The next holding that I have in the portfolio is Polygon or Matic. This is a layer 2 scaling solution for the Ethereum protocol. Really cool thing about Ethereum is that it allows you to do things like smart contracts and store of value and decentralized finance and build technologies in Web3 on top of that technology. The issue with Ethereum, though, is that there's only so many Ethereum transactions that can happen at any one good time. And if the goal for the network is to scale up to a very large place, it's going to be difficult to do so when you can only validate and have so many transactions go through at any given time. The goal is to be better than traditional finance, and until Ethereum can do that, it's hard to sell. Now, what Polygon is allowing us to do is actually bundle up these transactions off-chain, send them to the main Ethereum network to be validated, and it rapidly speeds up and increases the speed of execution for new transfers to take place within the space. I think that's a really cool technology. I'm a Ethereum bull by nature, and of course I'm holding some Polygon by consequence of that. Now, the next token that I have here is Render token. Render is a really cool protocol where it's actually allowing for decentralized GPU processing. This is going to get a little bit more technical for you guys who are more well versed in traditional finance, or just you watch the sports game on Sunday, so why do you care about any of this? I think Render is revolutionary technology for computers, and to explain what the Render protocol does, In your computer, there are a lot of components which are really important, but the three main ones, if I were to, just kind of boil it down to my perspective, would be your CPU, your central processing unit, your RAM, your random access memory, and your GPU, your graphics processing unit. And what a GPU allows you to do is, if your CPU is what is letting you understand and interpret and read all this information coming from the internet, your GPU is what allows you to visualize it and see it. And GPUs are really useful for a number of things. One is video editing, creating Photoshop edits in Adobe Workspace, video content, streaming, gaming, things along those lines. And the issue is, for people that don't have access to high-powered machines for really intensive, think like 3D modeling, making movies like the Toy Story, it can be challenging for them to actually do those renders, to produce those videos and that content without access to that equipment. What Render does is it actually allows GPUs from all across the planet to be utilized by people that don't actually own them to run those processes, to render those videos, to make those graphics. And you use the Render token to actually pay for said services. And in owning the token, I am participating in that network. And then the goal is that if more and more people are trying to use the Render network for these processes that I was talking about, then by consequence, the Render token is going to increase in price as well. So that's part of the reason why I own it. Now, the next token that we have in the portfolio is Filecoin. Filecoin, I think, is a very interesting project where, just like with Render, where they're doing decentralized GPU processing, Filecoin is actually doing decentralized file storage. Think of platforms like Dropbox, Google Drive, things like Apple iCloud. I haven't used that in decades, but Apple iCloud is another example. The goal of Filecoin is actually to allow people to decentralize the storage of their data online, and in the same way that a GPU for Render is going to be used to actually run renders, storage, think SSDs, M.2 drive, hard drives, are going to be storing small pieces of information which can be accessed by the end user to actually store their data in a way which is sovereign, in their own control, and not controlled by a centralized entity. I think there's been a lot of talk in these past few years, especially since the mid-2010s, about the centralization and control of our information by big companies. Excuse me, I'm gonna take a drink of some energy drink here. And for people who are a little bit more conscious about, who actually has access to their data, where is it going to be stored, who is that data going to be sold to into the third party, Filecoin's a really interesting solution for actually mitigating some of those risks and taking control back over of your own data. That's why I participate in the network as well. Now, the next token I want to talk to you guys about is Kava. Kava, I think, is super cool. It is a decentralized financial platform which essentially takes the bank out of banking, and Kava is the token in which it's used to actually manage said transactions. Kava can allow you to do things like lend out your tokens for yield. Think of the same way that a government bond would work. The government needs some money. They're willing to pay you interest rate for it, and then you as a consumer will buy bonds from the government, and in return they'll pay you back a monthly coupon, sometimes less often, and then at the end of the term you'll get back your principal. Decentralized finance works in a similar way in regards to lending, because you can actually lend out your tokens or provide them to what's known as a liquidity pool for other people to borrow, and then you can gain a yield based on what the market's willing to pay you for it. This would probably deserve its own video breakdown on its own right, just given all the applications of decentralized finance, but we'll get into one of the reasons why I'm holding it in a sec, because there is some staking returns that I want to talk to you guys about as well. Next token up is VeChain. Think of business supply chain management bundled up into a token. That's the main goal of that. To continue moving along here, the next token that I have ownership of is a token called Chainlink. Chainlink is really cool because, in the same way that Polkadot is allowing for one blockchain to communicate to another, which it normally wouldn't be able to, Chainlink is actually connecting not only blockchains but real world data into blockchains. And I can think of a really applicable example for traditional finance. Let's say you have a securities based line of credit issued against 1,000 shares of Apple. And as you may or may not know, if you actually draw from a line of credit and then the value of the underlying asset goes down to a certain degree because they've lent you now more than they would have feel comfortable with, and based on the underlying value of that asset, they'll actually give you the chance to either send them more money or they'll sell off some of your shares to pay back that line of credit to a place where they feel comfortable with it. Now, all that's going to have to happen individually by somebody in a bank monitoring the portfolio, monitoring the outstanding balance of the line of credit, and then in the event they need to margin call you to sell some of your position, they'll do so manually. Cool thing about Chainlink is that by having access to real world data and then connecting it to something like Ethereum with smart contracts, the automated execution without third party human interference of a financial transaction, you could actually automate the instance and margin calls in a way which would potentially reduce risk for not only the lending institution, but potentially even the person that's actually borrowed that money. Because what if your portfolio didn't go down by 5 or 10%, it went down by 90 in a period of a day due to a rug pull? Not good. Two more tokens to talk about here. So we got Fetch AI. Fetch AI is a blockchain-based AI company that is allowing AI technology to be integrated within some of the things being built on the Ethereum network. In the same way we were just talking about how Chainlink could potentially automate the instance and margin calls, think about adding a chat GPT-esque large language model AI focus on top of these other technologies and decentralized platforms. As a thematic trend, cryptocurrency side, I do think that AI is going to be increasingly important into the future. AI integrated applications are going to allow end users to do more work in a faster pace in a shorter amount of time, and I do want exposure to that trend, and I think Fetch AI is the way that, at least within the cryptocurrency space, I'm doing so. Now, the graph is a really interesting one. This is a utility-based cryptocurrency token that's sole focus is on indexing blockchain information. Now, while blockchains are a publicly available ledger, you can see the transactions, where money's gone and where money's went over basically the blockchain's existence for whichever one that you're looking at in question. There's a hard way to conglomerate, to synthesize, to extract trends and specific information from these chains, and part of the reason for that is just it's a chain of transactions. It's not indexed into any searchable field. The goal of the graph is to actually index multiple blockchains into a way where it's easier for developers and users, theorists, economists, statistics, etc., to identify and access and understand recurring and important trends that are happening on cryptocurrency transactions. The graph token is actually the token that is allowing that to happen, and that's part of the reason why I take ownership of it. Now, I actually want to go into each one of these holdings and let you know kind of like my thoughts on where they're going to be. So let's go over into, let's go to prices, and then let's go to my favorites. Asking me to sign in, so just bear with me a sec. Video is going to go blank for just a moment, guys. All right, so we are back looking at the stock charts or the crypto charts or whatever kind of charts that you want to look at it as. Bitcoin is doing pretty well right now. We're in a bullishly uptrending market, but when you go out into a little bit of a longer term, let's actually look here. This was the peak that we had saw during the last bull market, just barely getting to $70,000 and then retracing about 80% down to 15,000. This to me looks like a very good chart right here, and that's part of the reason why, as a base, I have a good portion of my portfolio within the Bitcoin blockchain. Going to my favorites here, I think let's actually focus on the weekly price chart as or daily. Might give us a better insight as to where the market's going to be. So we're looking at Polkadot here. We have, as far as Binance's graph, which is not the most indicative because it only goes back until 2021 when it was listed onto the exchange. During the last bull market, Polkadot hit a high of above $50. Right now we're trading at $4.09. Zooming a bit closer, we're looking at a bearish trend here. And while I'm no true technical analyst here, we have lower lows, lower highs, and then decreasing volume, so we do expect some further price declines for the Polkadot network. Going into Ethereum is having a very similar setup as the Polkadot did as well. Had our all-time high here in 2021, selling off in 2022. And while there was a bit of an increase back up to the $2,200 range here, it hasn't been able to sustain these highs, and I think really we're waiting for the Bitcoin halving to get us back off into bullish territory for a lot of these tokens. Going into the next one, Fetch AI. Fetch AI is actually holding up very well since being listed onto the Binance exchange. It had a low of 53 cents here, ripped up to a high of 87 cents here, and I think this is just mostly rampant speculation and people just buying things they didn't really understand. And in the same way, we had a retracement back down to what is a more fair value, and we're consolidating here at the 20-cent level. Long term, I do see Fetch AI going above its all-time highs. The question is, when is the next bull market going to get new consumers, new people into the market to actually start buying these tokens? Clearly is not today, so I'm just building on my position as well. Now, Filecoin, I love this project, really do. Had an all-time high of 120 bucks. We're trading here at $3.4, getting a little bit closer into the more recent charts. We had a local high of 12.4, was not able to sustain that, and we've been selling off ever since. So we hit a low of 2.5. Tried to retest it here, looks like at about $3, and we've been sustaining that low for the time being. So I see the $3 price point for Filecoin as a buy zone. I've been accumulating since about the beginning of August and will continue to do so until I reach my price target. We'll get into that in just a second. Going into the graph has been a shit show as far as price appreciation goes. I mean, it hit 2.24, and then it's just been trading down to essentially zero ever since. I do fundamentally believe in the project, and that's why I continue to buy into it. Definitely not for the faint of heart. This is an altcoin as far as altcoins are concerned, and with higher risk, further out in the risk spectrum that you're going, the more likely you are to blow your portfolio up. So don't get involved in this unless you're okay with some volatility. Me, I am. I got a long time horizon for my investments, and I do believe in the space as a whole. Kava, basically we're just in consolidation range. We've been range bound between, call it 50 cents and $1.20 since as long as it's been listed on the exchange here. We had that local sell-off with the beginning of FTX's liquidation, and then we've been essentially consolidating around the 50-60 cent level ever since. Again, I think Kava is another cryptocurrency which is going to need a catalyst to get us back into bull market territory. Until then, just stacking my sats, stacking my Kava, doing what we have to do here. Next, we got some Chainlink. Chainlink has been on an absolute tear this past week. We're talking about over 50% price appreciation from a low in the beginning of September, called $6, up to a high of 8.258 it was actually just a few days ago. So I've been really happy with this price appreciation here, and there's been a lot of hype going into the Chainlink ecosystem, just given a lot of the partnerships that it has. So definitely be on the lookout for, big spikes up in price. Now I have Loopring listed here as a competitor token to Polygon, but I've essentially decided to move forward with Matic. So let's actually click on Matic and see what's going on here. So for Matic's price, we have been extremely volatile these past few months. During the bottom of the bear market, we hit about 30 cents per token, went up to 2.75 in the basically beginning of 2023, and now we're consolidating around the 56 cent level. Matic is going to be very closely tied to the Ethereum price, and until Ethereum sees any bull markets and catalysts, Polygon's going to be in the same place. Render token, absolute beast. This is the most bullish chart I think you can ask for. We have a rip up to 532, consolidation back down. I think this was a 38.2 fib retracement level if we put that on the chart later, to 83 cents. Retesting a high of 2.98, consolidating back to a higher low of 1.31, and then we're at, call it about 183 today. We're seeing some pretty bullish price action in the recent chart, sustaining what is that moving average? The 99-day moving average, so call it the 100-day moving average, staying above the 25 moving average and 7-day moving average. To me, this chart just looks like just a beast. So I'm going to continue to stack my render tokens and get on with that. Now, given that we're hitting about the half-hour mark, I don't want to take all your entire day with this, so let's get into the reason why I'm holding these specific tokens and kind of the goal, the thesis with the mining operation here. First and foremost, you see here I've been earning rewards about $81 within the past 2 months, $25 within the past 7 days based on the stake balance of $4,632.77. Now, why I'm actually holding these tokens? Well, the reason is because I am earning rewards. Kava is yielding as of today 11.5%. Ethereum, which is still in the process of being staked, as you can see here, about 4.10%. VeChain's earning 1.1%. Polygon is earning 4%. Fetch AI is earning 4%, and then Polkadot is earning 13.3%. So really, in a big picture sense, what I've been doing is mining, getting Ethereum Classic, getting Zilliqa, selling that immediately, diversifying into the lowest valued position into my portfolio until I hit specific price targets, which we're about to get into, and then immediately staking those proceeds into staking pools like with Binance to earn rewards. And let's get into actually some of these profits that we've been seeing here. So this is a tool called Coin Ledger. This is how I'm actually tracking my cryptocurrency profits, and I need to categorize some of these mining income instances that I got here. But this is a really cool platform, as it actually is a tool that can skim your different brokerage accounts and all the transactions that you've done within the blockchain space and cryptocurrencies to actually produce taxable income forms for when you actually have to file your taxes. Now, given that I'm mining out of an LLC, this is extremely important given that I need to file quarterly taxes to actually report my taxable income. I also like this tool because it gives me a representation of how much money that I've earned so far, lets me know if my operations are profitable, and at this time they are, despite my higher cost of electricity, given that I'm staking some of the rewards. And it's kind of nice every morning to see like, oh, I'm getting paid, made some trades, getting paid, made some trades, getting paid, made some trades. And the cool thing is, every time I stake, you can actually see how much rewards you're expected to receive. I just staked earlier today into Kava and VeChain with some of the profits that I received from the mining operations that I did, earned myself a 12-cent raise. Now, you may be saying to yourself, well, a 12-cent raise, I can't even buy you something from Dollar Tree. And you're right. But I think over the long term, with price appreciation, restaking into these pools, and basically just letting compound interest, the eighth wonder of the world, do what it does, it's not going to be a 11-cent raise. It might be a $100 raise. And you do a $100 raise every day for 3, 4, 5 years, well, you're looking at a pretty good spot. So getting into profits for the portfolio so far, going into my 2023 tax report, you can see here that I've made $1,000 in short-term capital gains, made $244 from mining, $60, which is not actually reflective of the most recent distributions that I received, so I gotta add these into Coin Ledger. But we're looking at about, just from like the crypto staking and mining operation, called about $330 for 2 months. And considering I just plugged in the machines and they're doing what they do, I think I'll take it. So next thing that I want to do is actually add in these transactions into the portfolio, because one of the things which I think is super important for you to do is to actually understand where your profits lie and how you're doing in the big picture of things. So this is, let's actually take a minute here to talk about this. This is how I'm actually tracking in my portfolio allocation. So the goal is to build out the portfolio to $25,000. Donate to me, like and subscribe to this page so we can reach there a little bit faster. The goal is to have 45% allocation to Bitcoin, 10% to Ethereum, 10% to Polkadot, 10% to Kava, and then for some of these more niche and further out in the risk spectrum altcoins, I've reduced my position here. So we've got a 7.5% holding position to Kava, 5% to Chainlink, 2.5% to Fetch AI, VeChain, Filecoin, The Graph, and Render. So one of the things I'm going to do after this video is actually update this Excel to let me know how much income that I should be expected to receive, because I built out some formulas to let me know what that income is going to be looking like. But long term, the goal is to have an allocation of these for these respective tokens. And then as of the last time I updated this Excel, we're looking at weekly income about $24, monthly income about $102, and then annual income about $1,200. So just for staking on a protocol and having, $1,000 in rewards every year just for having that plugged in, I think I'm a happy camper in that regard. So to wrap up this video, I want to talk to you guys about some of the news that we've been seeing in the cryptocurrency space. So first and foremost, from Reuters, we got US regulators weigh on penalizing bankrupt crypto lender Voyager's ex-CEO. It's coming from both Voyager and Bloomberg and Reuters, but anyway, investigators at the U.S. Commodities Future Trading Commission's Enforcement Division have concluded that the co-founder of Voyager Digital broke derivatives regulations before the failed crypto lender plunged into bankruptcy last year, according to Bloomberg News. The regulator intends to accuse Stephen Ilrich of breaking its rules by misleading customers about the safety of their assets following a probe into Voyager's conduct. The report added, citing familiar people with the matter. Now, having spent nearly my entire career working in regulated markets, including more than 10 years in publicly traded companies, I've never had a single blemish on his record. Well, of course, if you did something bad, you you'd say you're a good guy, but no one cares. As a reminder, guys, Voyager is one of the cryptocurrency exchanges and hedge funds that filed for bankruptcy in July last year, was a casualty of the bear market. And I think this speaks broadly to the notion of leverage within traditional finance and finance in general. If you are leveraging your assets, you are going to see higher profits and higher losses. And for a space as volatile as cryptocurrency goes, it's always been my take that you shouldn't use leverage unless you're doing a strategic, very well thought out and a well planned out trade with a high degree of certainty, which is not the case when prices change so dramatically in the industry. Rather, I think it makes a lot more sense to buy in cash, to know your risk management, and to be willing to lose anything that you put into the space, rather than leveraging up an asset which could, turn out like FTX and go to zero pretty quickly. Heading into the next news articles, we got some news about Jefferies finally coming around the corner and realizing that Bitcoin is a inflation hedge. It is a safeguard against currency devaluation and rising inflation. It looks like here Christopher Woods, Jefferies' global head of equity strategy, expressed concerns about the ability of G7 central banks, including the Federal Reserve, to transition away from unconventional monetary prices smoothly. Let's actually break down what that means in kind of layman's or simpler terms, right? In 2008, and this had been happening far prior to 2008, but the Federal Reserve, the US government, came out in full force, printed billions and trillions and quadrillions of dollars, I say that hyperbolistically, of course, to backstop the fallout of the housing market. And ever since then, we've been in a low interest rate environment, meaning where the Fed has kept rates artificially low, lower than they likely should have been, what would have been set by market prices, to incentivize growth and reinvestment into the US economy. Now, as a consequence of that, people have transitioned into riskier assets for the sake of finding returns and yield, as opposed to what they could get into the bond market yielding, back at that time, 0% interest, 1% interest, 2% interest rates. When that happens, you have a increased allocation in people's portfolios, people meaning individuals, institutions, hedge funds, and pension funds, into riskier assets, and less investment into the bond space, as there's not a lot of yield to be found there. And it's very difficult, and one of the things we're seeing as the Fed has been rising rates in these past few weeks and months and years is that now that there is actually a yield on US government bonds, people are reallocating back into them. Simply put, if I can get 5% from a 10-year treasury and with a guaranteed return of that 5% and my principal to be given back to me by the US government, backed in full faith by the fourth of US credit, then why would I say invest in a penny stock or a crypto or Apple stock or any stock when I can just have a certainty of 5% yield? And for some people in a certain part of their life, I think that's the exact right decision, because why take on more risk than you need to take on? Now, for people interested in the risk on space, to think your traditional equities, real estate, cryptocurrencies as an example, this can become a negative catalyst, because if people are not pouring cash into their investments that you also have participation in, price can remain stagnant, or if people sell, go down. So just something to keep in mind here. It looks like Jefferies, though, is starting to understand that Bitcoin, given that it has a fixed monetary supply, may have a role for people in their portfolio to actually act as an inflation hedge, and I'm totally on board with that. So good for you, Christopher Wood. All right. Now we got some ETF launch news. So what do we got here? Ethereum made its ETF debut with the release of 6 different futures products on Monday. That's exciting stuff. ProShares Advisors is behind 3 of the new ETFs, Ether Strategy ETF, and that ticker is EETH, Bitcoin and Ether Equal Weight Strategy, BETE, and the Bitcoin and Ethereum Market Cap Weight Strategy, BETH. Now, it looks like these ETFs do not directly invest in these cryptocurrencies, but they do track their futures contracts. Now, what is the importance of an ETF in the cryptocurrency space? Well, I think it firstly signifies that there's increasing institutional investment and interest into the industry if they want to release these products. Companies, knowing how highly regulated that releasing a new financial product is going to be and the risk in doing so, aren't going to actually put the capital, the time, and the investment into a new project if they don't think there's interest from their consumers for doing. The fact that a large company like ProShares is even releasing a futures ETF indicates that institutions are starting to change the narrative, the thought process, their belief systems around what a cryptocurrency is and if there's actually going to be use for it. And that's a really powerful thing, especially when we get regulatory approval for a spot ETF. Now, spot ETFs are different than futures ETFs because they're not a fund that is tracking what the market thinks the future price of the underlying asset is going to be. A futures ETF, a spot ETF actually needs to hold, to own, to be a beneficial owner of the underlying commodity, the asset, or whatever is being tracked in the fund. Now, that's important, especially for fixed supply cryptocurrencies like Bitcoin, because going back to the supply demand argument, Econ 101, if there is a fixed supply, an increasing demand, and institutions with millions and billions and trillions of dollars start to invest into the space, the natural consequence is going to be price appreciation. And the cool thing is, because these funds are not actively traded, meaning they're not buying and selling Bitcoin from the underlying fund, they only buy as much as that there is demand for the underlying fund as well. The more people that buy into the ETFs, the more institutions are going to be buying up large portions of cryptocurrency, and that could potentially, if not mitigates the volatility, because they'll be holding that asset in a custody wallet, will at least potentially increase the price, be a consequence of demand. So exciting stuff here. Now we got Sam Bankman-Fried. This is maybe the trashiest picture I've seen of him. He looks like an 80-year-old man when the guy's in his 30s and has like cerebral palsy. But Sam Bankman-Fried's crypto empire was built on lies. I think we knew about all that. Oh, well, let's look at this here. Like, look, here is the rendering image of him. These are what our grandchildren are going to be seeing Sam Bankman-Fried as when he really looked like that. Okay. So we got New York CNN in their opening statements to a newly sworn judge in Manhattan federal court on Wednesday. Lawyers laid out their previews of the cases, offering two divergent narratives for the collapse of Sam Bankman-Fried's crypto empire. You know, people are saying that he had wealth, he had power, he had influence, but all that was built on lies. Well, why did they say that? Well, in Sam Bankman-Fried's defense, he's saying that he didn't defraud anyone. He's a hardworking guy. He's a math nerd who didn't drink or party. Factually not the case. If you hear about some of the debauchery that he did with Caroline Ellison, they actually touch on that a little bit here. But basically that they're saying, you know, he's like this smart tech guy who didn't know what he was doing. He was just trying to provide a financial good and service for the cryptocurrency space. It all unwound much faster than he wanted it to happen. There were things, quote unquote, outside of his control, and that's why FTX fell apart. Although we have some contrasting views here. We got his mother and father also on court for some debaucherous activity in the background. You have former CEO of Alameda, Caroline Ellison, saying that he had directed hedge funds from Alameda to take on riskier positions, took money from users' accounts. And I think over the next coming weeks and months, we're going to see full disclosure as to what happened in the FTX trial and the FTX fallout. What this tells me is just an individual participating in the space, because I can't give financial advice and no one really can, especially for cryptocurrency, is that there's always going to be a benefit to personal custody of your assets. And while we just spent a good portion of the video talking about me using Binance for staking, if all those positions went to zero, it would mean nothing to me. Because the only position that truly matters, that I have 120,000% faith in, which I know in my heart of hearts is going to go up in price, is that of Bitcoin. It is the antithesis to financial tyranny from the traditional finance system. It is the solution to the inflationary monetary policy measures that our Federal Reserve and central bankers are actually promulgating. It is a solution to providing banking services to the unbanked in third world nations like Ghana, Afghanistan. Well, they're not actually third world, but you get my point here. So I self-custody my Bitcoin. Other cryptocurrencies, which I view more as technologies, as tradable assets for something to produce yield, because the yield is best and simplest done on a brokerage exchange. That's why I hold it on Binance there. Just my 2 cents. But wrapping it all up into a bow, if you want to avoid losing your cryptocurrency, the best place to have it is in a cold wallet off exchange, like something like a Ledger or a Tezos, or I use Arculus. All right, a few more articles here. Looks like cryptocurrency fundraising is at its lowest level since 2020. Well, no duh, because we're in the bear market. The rainbow bears are running about. The cryptocurrency industry raised about $2.1 billion via 297 rounds in funding in the third quarter of 2023. This is the lowest amount raised since the final quarter of 2022. Looks like in the first quarter of 2022, we had a fundraising peak of 15 billion. So we're seeing massive mark-to-market decreases in how much people are investing in the space, and it looks like Binance Labs was the most active investor during the last quarter. Well, yeah, because when all these brokerage firms were falling apart, they were swooping in and buying up the assets. So yeah. What this reads to me is that as less institutional investors are putting money into early stage cryptocurrency companies, we're going to see a consolidation within the space as far as what projects are doing well, what projects are not doing well, which projects are going to be here for 5 years, which projects are going to be here for the next 5 months. As liquidity dries up in public markets and digital markets and markets in general, only companies that are profitable, have long-term credit facilities at reasonable interest rates, who aren't over-levered to the tits, are going to be able to survive. And especially in light of the Fed rising rates, liquidity drying up, we're going to see a further bifurcation of not only public markets, private markets, and then digital markets as well. I think the amount of fundraising that we saw in 2023 is just indicative of this, in that over time, until we hit a lower rate environment, until people have a lower risk appetite to other asset classes or willing to invest further into the cryptocurrency space, a lot of these new startup companies that are just looking for cash to release a product and then cash out may not get what they're looking for. And I don't really think it's a bad thing. Companies should be profitable. Banks should be sound. Central banks shouldn't be printing all this cash. And if less money into this industry will facilitate that happening, I say it's a good thing. FTX. And then just, going back into self-custody, it looks like Mark Cuban lost about $1 million through a crypto scam. So I hope you guys enjoyed the video. Really appreciate you taking the time to speak with me earlier today. Big picture, I think the goal is to release more content like this, call it like on a weekly basis, because I've been trying to work really hard at my 9-to-5 job in the meantime. But I plan on making some shorts videos for you guys later today, just so you can get my perspective on some of the biggest things that have happened in traditional finance. Thinking about doing that like Monday through Friday, and then on the weekends make a crypto video, catch you guys up on how the portfolio is doing. So on that note, be sure to like, share, subscribe. Let me know in the comments what you liked. Let me know what you want to see more of. Let me know what you didn't like. Let me know if you think I'm annoying or the man or somewhere in between. And in the meantime, let's turn our rags into the riches. Have a great rest of your day and an even better weekend.